Google is one of the most controversial stocks I own. I've been actively buying the stock at $151 a share, and it has since then risen to almost $180. I'm here to do a full deep dive on Google stock and to give you my opinion if I think it's a good buy in the market today. Now, many investors either have one of two opinions on this stock. They think Google is significantly undervalued and is a screaming buy, or they think Google is a dying company and should be avoided. I'm here to do a full fundamental analysis on Google stock and give you my opinion if I think it's a good buy in today's market. So to understand how Google makes its revenue, it's very important to understand where this revenue comes from. And Google is a very diversified business. Now, you probably all know that most of Google's revenue comes from Google Search. It actually makes up almost 50% of their revenue. However, this company is very diversified through other revenue streams, such as YouTube, Google AdSense, Google Play, and Google Cloud. And Google Cloud is actually the fastest growing of the bunch with a year-over-year growth of 28% currently. So I'm going to dive a lot deeper into these fundamentals, but it just goes to show that this is a very diversified business. A lot of these other sectors are actually growing faster than Google Search. So you have YouTube that's growing 10% year over year, you have Google Play that's growing 19% year over year, and then you have Google Cloud, which is the fastest growing at 28% year over year. So going forward, I could see a lot of sectors such as Google Cloud making up a bigger percentage of Google's revenue. And remember, this graph doesn't factor in some of Google's long shot bets, such as Waymo. Now, we could all make the argument that self-driving cars are going to be the future of vehicles, and I would tend to agree that down the line this is true. And this means that companies like Google investing heavily in R&D for future growth prospects could yield significant profits in the future. Although Waymo is not profitable at this moment, down the line I could definitely see it being one of the main revenue streams. Now, before I get too ahead of myself, let's go into Google's fundamentals. Whenever I'm analyzing a stock, I always look at a few key metrics to tell if this business is high quality. Here I have Google's total revenues pulled up, and the reason I think this is such an important metric is to understand if the business is growing. As investors, we don't want to be investing in stagnant businesses or businesses that revenues are declining. As you can see here, Google's business is significantly growing and it has been growing over the past decade. It actually returned a compound annual growth rate of 18.46% over the past 10 years. Now, taking a look at Google's free cash flow, we could see that it's been increasing over the past decade. Again, we want businesses that are not only highly profitable, growing in revenue, but also free cash flow positive. Free cash flow is one of the most important metrics in a business because it shows just how profitable a business is. If a business has negative free cash flow, it is a huge red flag for any investor. But seeing how this company has consecutively grown its free cash flow, it gives me nothing to worry about. Google's diluted shares outstanding have also significantly decreased, especially over the past few quarters. As a long-term investor, this is something I love to see in companies, especially since Google is trading at a 19 PE ratio at the moment. This may signal that the company is undervalued and management is prioritizing shareholder value by buying back shares. All around a very good combination. Looking into Google's net profit margin, we like to see this as high as possible. High profit margins lead to a bunch of positives in a company, and I like to own companies that have some of the highest margins on the market. If a company is growing its revenue and increasing its net margin, this could be the definition of a compounding machine. Looking at Google, I could see that the current profit margin is 30.9%, which is a very high margin for this company. I also notice a slight pattern of these margins increasing over time, and I feel like with the expansion of Google Cloud and how fast it's been growing, I think that these margins could get significantly higher if it becomes a larger portion of the business. This is something to consider if you plan on holding the stock for decades as I am. Last but not least, I always look for companies with a return on invested capital, return on assets, and return on equity that is quite high. I want to be giving this company $1 and I want them to return me $1.20 or $1.30 on that dollar. And when I look at Google's return on invested capital, I can see that it's quite high at 31%. So that means Google is earning a high return on capital that's invested with them. I could also see that the return on assets and return on equity is also quite high, with a 25.1% and a 34.8% respectively. So all around, Google's fundamentals seem to be very strong, and it seems to be the definition of a compounding machine. But looking at the PE ratio for Google, you could see that it's at a 19.8, which for a company this high quality, it seems quite low. So we have to ask ourselves, why is this company being priced at a slight discount? This is what leads us to Google's bear case, and this is what many investors think will happen to Google if Google fails to innovate and fails to take advantage of AI. So I have a few opinions to share on these bear cases, and I'm going to start with AI and search disruption. As you guys know, with the introduction of ChatGPT and other LLMs, Google's moat faces a significant disadvantage because Google search makes up almost 50% of its market share. And that bear case may partially be correct. You might say, hey, Google makes up almost 50% of the search market share. LLMs are going to take this away from Google and Google is going to decline in revenue. Now, this would be a very logical argument if it actually showed in the numbers. And this is where we get into a bit of a problem for the bear case, because if you look at Google's numbers, and I'm going to pull them up here, there actually is no decline in search. Obviously, search has been growing significantly over the years and has continued to grow significantly over the past few quarters. What I have here is Google's search revenue pulled up, and as you can see, it has been significantly growing over the past few quarters. People will still argue that, hey, search revenue has significantly declined since 2020 to 2021. It's been growing at almost like 50%, and now it's only growing at 9%. I agree with that completely. I agree that Google search has been slowing down, but that is to be expected because Google search has been such a big growth driver for the past few decades. So now we have to ask if Google has just saturated its market share or if it's actual LLMs that are slowing down Google's growth. This is where we get into the discussion of AI, because if Google is getting taken market share by AI, Google must be significantly behind in AI because consumers are going elsewhere. But if you look at the statistics and you look at the technology Google has, that is not the case at all. As a matter of fact, Google actually has some of the strongest AI models, and Google also has some of the best AI technology on the market currently. Now, the video you see on screen may look like a normal car show, but it's actually made using Google's new AI. And honestly, when I look at a video like this, I cannot tell if it is AI or not. I might notice a few small details that might give it away, but if I take a quick glance at a video like this, I could not tell if it's made by AI or not. And this just shows how advanced Google actually is. Like, a lot of AI models can't generate content this high quality. So this just shows that Google is really advanced with their AI technologies, and they're spending a lot of capex on these technologies too. It's not like they're not heavily investing in these businesses. They're investing heavily into these businesses. Billions and billions of dollars are going into AI, and this just shows the result of the high capex. So then what's left of the AI and search disruption bear case is that Google might not be able to generate enough revenue from the new AI technologies they are giving out. Let's see what the CEO has to say of this.
Is Google being disrupted by AI at this moment, or is Google leading?
So, I think even the last couple of years, I viewed this as an extraordinary opportunity for search. I think if you look at how much information means to people, I think each person is going to have access to information in a way they've never had before.
He does not point out that AI might cause disruptions or problems with search, but it's more of an opportunity. And I think this is the best way to put it with Google. Google is one of the best positioned companies to take advantage of AI. They already have all the customers using search. All they have to do is implement AI into their search engine, and this would create massive opportunity. I would argue that Google and Apple are the two most well-positioned companies to be involved in the AI market. These two companies already have the hardware. All they need to do is implement the software for this function, and they would have exponential growth in the sector continuously just because they already have the base clients. It's the same idea with Microsoft and cloud. Microsoft already has the Office ecosystem, and clients trust Microsoft a lot. They trust them with their files, they trust them with their personal data. So when you add cloud to the bunch, clients have a lot of trust already with the Microsoft platform, so they are more inclined to use Microsoft Cloud. And that's why Microsoft Cloud has actually been growing faster than the other cloud services. And I think it's the same thing with AI. If people love using Google search, or if they love using Apple products, adding AI to these products would just make the experience way better. And I feel like Google is the best positioned company to be doing this. And video generation is not the only thing Google has actually been working on. There is also Gemini 2.5 Pro, which is a better version of the current Gemini. And there's many other AI models and features showcased in the keynote presentation. I'm just going to give a quick overview of each one. And yes, you may notice that I got pretty badly sunburnt. I was actually at the F1 event and the sun was very, very bright and very, very hot. So I basically got sunburnt all over. All right, back to the showcase. Now, there was a model introduced that actually translated in-person speech to a different language. So if you speak to someone that's French, for example, and you're English and you can't understand French, the Google Translator using AI would actually translate the words that are being spoken into the language a person could understand. and the person who speaks back in that language would actually be able to speak back in their normal language. So I thought this was very interesting and would definitely drive clients to use Google's AI more and more frequently, especially when traveling or in different countries. Another AI model that was shown was actually an advertising AI that helped you pick different clothes and items online by showing your figure in these clothes. So basically, you could be shopping online and you could see if an outfit fits you just by using AI and having your picture taken. So this will definitely help shoppers online see if something looks good on them, and it will make them more inclined to buy these products. And the reason I think this is so important is because advertisers will actually be paying a lot more to have this AI feature be available. Think of it from an advertiser's perspective. If you run ads, you want to have the most efficient shopping experience possible for these ads. You want to earn the most revenue possible, and this just simplifies the whole process. This will probably significantly boost sales, which results in higher advertising revenue. The last thing that Google showcased that I also thought was very important was Android XR. So Android XR is basically a pair of glasses that has AI and virtual reality integrated into them. So as you can see on screen, there's a bit of a heads-up display, and you have a woman here wearing a pair of glasses. And these are the Android XR glasses. So in this video, she actually asked the glasses some questions, and the glasses respond to the questions. And I think this is something very interesting because this could actually be the future of mobile devices. Instead of people having phones and carrying phones around, they're going to actually have these glasses, and these glasses could do everything that your phone can. So there's a probability that this is something that happens in the future. We're just not quite there yet with the technology, but I feel like in the future, we could definitely see this becoming a new trend. So why am I showing you all of this? Well, it's to answer the question of if Google is a dying company or not. So you have companies that are struggling and that are visibly struggling in their metrics. And Google is by no means one of them. You can actually see that search revenue is growing. Almost all of their revenue drivers are growing, and some even growing at over 20%, like Google Cloud, for example. So you have Google Cloud that's growing at 28%. You have Google Search that's growing at almost 10%. So this is not the sign of a dying company. And not only that, but you also have the fact that Google is at the forefront of AI. Google is leading the AI race. Google is literally one of the competitors for who has the best AI model. So you have a company that's still growing, that's growing quite fast, and that is at the forefront of AI technology, but it's being priced as a stagnant company. If you take a look at Apple and how they're priced for what they're growing, you can see that Apple has been stagnant for a couple quarters now. But Google has a lower multiple than Apple by a significant margin, and yet they're priced as a company that's declining in growth when in reality, it's the opposite. So I think the bear case of Google having AI and search disruption is a bit overblown in my opinion. So the next argument people have for Google is going to be the slowing ad revenue growth. Now, it's no secret that Google's ads revenue is slowing down, and Google Ads actually makes up a big portion of the business. Over here, I only have shown YouTube ads, but there's a lot more to Google Ads than just YouTube ads. Every search you make on Google actually has sponsored ads on it, and that earns Google significant revenue. So the argument of if Google is going to earn less in ad revenue from AI and AI disruption is, I think, a bit overblown. And the reason being is because even the CEO himself said that he thinks AI is a significant opportunity for Google. As mentioned before, I think AI could benefit Google advertising in the long run. The reason I'm so confident in this thesis is that AI could actually make a lot of things efficient. It could make the algorithms used to find ads for customers very efficient. It could create instant personalized ads for Google. The reason I mention this is because Meta and Google are two very heavily reliant on advertisement companies. And these advertisers are spending so much into the development of advertisements. A huge percentage of revenue goes to making advertisements. They have to hire developers, they have to hire editors, they have to hire photographers to take pictures of the product. There's a bunch of steps involved to create advertisements. If Meta and Google could funnel that revenue to them somehow, it could create exponential growth. It may seem like a very far-fetched idea, but Meta was actually in the talks of creating an AI model that creates product advertisements for the advertisers directly. So we may not be far off from having this as a reality. Now, competitive pressures in cloud is something I hear about often with Google, and I hear this often with not only Google, but other companies too in the Magnificent Seven. Cloud is a new growth driver for pretty much all big tech companies. Even if you look at the rates at what cloud is growing at right now, 28% on the year is not a bad growth rate at all. Obviously, we're not going to see 100% year-over-year growth rates anymore. Although it might be slightly slowing, I still think there is potential for it to expand even further. It's a 6.21 growth rate quarter over quarter, which if you think of from a logical perspective, These are very impressive growth rates. Even with some slowdown, this growth rate is still very impressive for a business of this size. This is still a relatively smaller portion of the revenue. As mentioned before, I could see growth in this sector significantly, especially with the new demand for AI and data centers. Cloud is going to be necessary in the future. The last bear case I'm going to mention is the margin pressure from investments. The business model of Google has shifted over time. It used to be just a search platform, but now it's shifting to more of a cloud and tech platform, and Google is now known as a big tech company. To generate revenue with cloud, you need data centers, and data centers are very demanding. You have to invest heavily for GPUs and processors, then you have to earn a return on this investment in a relatively short period of time, because these processors do not last decades. They last 5 to 10 years at most. We're starting to see this in the numbers over the last 10 years. So looking at the capital expenditures, which is the capex of Google, you're going to see that it has increased exponentially over the past decade. So we started off in 2015 with over $9 billion in capex, and we go all the way down to now, and we're sitting at $57 billion in capex currently. This becomes a shift in Google's business model, and it could also explain a slight multiple compression. But we have to take a step back and look at what exactly these capital expenditures are. So yes, Google is spending a lot more money, but if I go here and pull up the return on invested capital, you're going to see that the return on invested capital has been slightly increasing over time. So Google is spending more money, but they're also earning more money on that money spent. As an investor, I don't necessarily think this is a bad thing. If I saw any margin compression or any significant slowdown in certain revenue streams, I would be concerned for this company, but as recording this video, we are not seeing any of this. So should you go out and buy Google right now? Well, it's a bit of a difficult question to answer. First of all, I do think this company provides the best value out of all the Magnificent 7 stocks, aside from maybe Amazon. It's trading at a relatively low PE ratio. Looking at the PE ratio over the past decade, it's trading at one of its lowest points. Obviously, it doesn't provide as much value as it did at $151 a share when I was buying this stock, but I still think it does provide some significant value in today's market, especially with how overpriced most stocks are. You have a company that is growing over 10% on the year, and you also have a company that has a bunch of tailwinds benefiting it. You have the benefit of AI, you have the benefit of autonomous vehicles, you have the benefit of negative market sentiment that is punishing the stock price currently. So you have a lot of opportunity if you're thinking to invest in Google. Obviously, there is some slight risk, and you should never take my advice on if you're buying a stock or not. I'm just here to give my opinion. But I do think Google does provide some value today. I hope you all enjoyed. Thanks for watching.